Welcome to Breaking News to Trading Moves. When engineers construct a suspension bridge, the mathematics involved are, well, they're entirely absolute, right? They calculate the physical load, they measure the exact tensile strength of the steel cables, and they factor in wind resistance.
Right. And assuming those calculations are precise, the bridge will hold the weight. It basically operates as a predictable, closed system based on physical laws.
Exactly. But when an individual actor enters the financial markets, it's like trying to construct that exact same suspension bridge in the middle of a Category 5 hurricane.
No, absolutely.
Yeah, where the laws of physics are just altering their behavior millisecond by millisecond with literally no warning. We are looking at a mathematical and structural environment that is incredibly hostile to the retail participant.
Mm-hmm. And the real question we are facing is how to actually survive it.
Spot on. So today, we are evaluating the viability of retail market participation. Specifically, we are looking at whether intraday trading or multi-day swing trading offers a more credible, mathematically sound path to profitability for the individual actor.
And that is exactly the core of our disagreement today. I maintain that day trading, particularly when executed through modern simulated prop firm structures and, utilizing electronic communication networks, offers superior risk control. It's a highly viable path for capital extraction.
Well, I will argue for the structural superiority of swing trading. The intraday environment simply contains entirely too many statistical disadvantages for the average retail trader to overcome.
I guess we'll see about that.
We will. We are going to map out these methodologies by connecting the dots between empirical market data, university research, and current brokerage statistics. My perspective is that retail participants simply cannot compete in an intraday environment. It's dominated by algorithmic speed, transaction friction, and just constant noise.
But the noise is exactly where the opportunity is.
Let me finish this thought, because the numbers here are incredibly stark. Look at the Cambridge University study that tracked 5,472 UK retail traders over a 3-year period. That empirical data showed swing traders averaged a positive 2.1% annual return.
Okay, but
Wait, let me give you the other half. Day traders averaged a negative 3.8% return after costs. We're talking about the sheer mathematical drag of commissions.
Right, let me jump in there because that cost argument often lacks context.
I hear the argument for having intraday control, but let me offer another angle on those costs first. If a retail actor makes just 100 round-trip trades a month at an $8 per trade commission, that equals almost $10,000 annually just in overhead.
Yeah, if they are paying retail rates.
Which most of them are. Imagine you are trading a $20,000 account. You would have to generate a 50% return just to break even on the fees. And that is before factoring in slippage or spread markups or taxes. I see why you think that, but let me give you a different perspective. By stepping back, avoiding that intraday noise, and holding positions for days or weeks, a swing trader aligns much better with institutional trends. They also operate in the reality that actually accommodates managing a full-time job.
I come at it from a different way. Day trading is highly viable if the participant actually understands the true nature of the arena. They are playing a zero-sum game against other unskilled retail actors, not against institutional algorithms.
Unskilled retail actors?
Yes, exactly. Consider the Garvey and Murphy research on direct access brokers. When they analyzed 1,386 day traders, the data revealed that about half were actually profitable after paying all commissions.
Half? That seems unusually high for retail.
It's what the data showed. The successful cohort in that specific study generated over $9.5 million in net profits over a 3-month period. Plus, day trading completely eliminates one of the most destructive variables in the market, overnight gap risk.
Well, we will get to risk profiles shortly.
But it's crucial. When the closing bell rings, your exposure goes to zero. Furthermore, the landscape has changed. Simulated prop trading models have completely altered the risk profile of intraday activity. Participants pay a small one-time evaluation fee, usually ranging from $42 to $467, to access up to $100,000 in virtual capital. You no longer need to risk your own personal wealth to participate in the intraday market.
Let us look closely at the raw cost of frequent trading, though, because the friction is exactly where retail accounts bleed out. We have to look at the mechanics of this. For traders executing 8 round-trip trades daily, trading expenses can consume up to 70% of their daily trading volume over the course of a year.
Assuming they aren't getting rebates, sure.
Even then, consider the massive study the 19,624 individuals who began day trading many equity index futures in Brazil. Over a period from 2012 to 2017, an astounding 97% of traders who persisted for more than 300 days lost money.
Wow. 97%?
97%. Only 17 individuals out of almost 20,000 managed to earn more than the equivalent of Brazil's minimum wage, which was about $16 per day. Operating in a high-frequency retail capacity is like trying to fill a bucket that has a massive hole at the bottom.
A hole being the fees?
Exactly. The water is your capital, and the hole is the bid-ask spread and broker commissions. You have to pour capital in at an astonishing rate just to keep the water level steady, let alone actually fill the bucket.
That is a really vivid analogy, I'll give you that. But it assumes the trader is always the one paying the toll rather than the one collecting it. Sophisticated day traders understand how to provide liquidity rather than consume it.
How so? Retail traders don't dictate the spread. Think of an electronic communication network, or ECN, like a busy highway toll booth. Usually you pay to drive through. But if you are the one bringing traffic to the highway, the toll operator actually pays you. The Garvey and Murphy data shows that placing limit orders on ECNs can earn traders a liquidity rebate.
But those rebates are tiny fractions of a cent.
Sure. Capturing a rebate of a fraction of a cent, say $0.002 per share, might sound small, but it entirely offsets a standard $1.50 to $3 commission charge. The institutional traders in that study were earning rebates averaging $2.36 against a $2.25 commission. So they were essentially getting paid to trade.
Exactly. They place limit orders on roughly 2/3 of their trades. The hole in the bucket can actually be plugged if the participant understands market microstructure and uses maker-taker fee models to their advantage.
Look, I am highly skeptical of that line of reasoning. Accessing those specific rebates typically requires execution setups, direct market access software, or volume thresholds that the average retail participant simply lacks. Most retail platforms route order flow to wholesalers, meaning the retail trader never sees a dime of those rebates.
Well, they need to use the right brokers, obviously.
More importantly, retail traders generally consume liquidity because they act on pure emotion. They hit the market order button to buy instantly when they panic about missing a move, or they hit the market order to sell when they are terrified. That action crosses the spread and pays the maximum fee.
Yeah, the emotional component's tough.
It's devastating. When you look at the S&P 500 delivering annual returns of 11% to 17%, active retail traders underperformed the market by 6% to 7% annually after accounting for costs. The Tuco trading data from the SEC investigation proves this reality. Even at a proprietary firm with professional setups, 84% of their active traders lost money. The friction is relentless.
Some do consume liquidity, absolutely. Many panic and cross the spread. But we are evaluating the proper, mathematically sound path for profitability, and that path does exist. You mentioned transaction friction and capital limits. Look at the pattern day trader rule in the US, which mandates maintaining a $25,000 balance for intraday trading.
Right, which keeps undercapitalized people out.
Or it used to be a massive barrier that forced people into subpar offshore brokers. Today, simulated prop accounts allow traders to bypass that capital requirement entirely. For a $46 evaluation fee, a trader can access a $6,000 virtual account with zero commission on indices, completely nullifying your capital friction argument. The landscape has evolved far beyond the traditional retail brokerage model.
That brings us to the environment where these trades actually occur. We cannot ignore the artificial intelligence factor. AI is expected to handle 89% of global trading volume.
Sure, Algorithms are everywhere.
We're talking about algorithms that process thousands of trades per second. They possess smarter order routing, adaptive execution, and they read and parse breaking news text instantaneously. Because of this sheer speed, short-term technical analysis is effectively obsolete for retail participants.
Obsolete is a strong word.
Traditional intraday support and resistance levels are entirely unreliable now. An algorithm can recalculate a position in milliseconds based on a macroeconomic data release. Think about competing against that. It is like sitting at a casino trying to manually count cards while the dealer is a supercomputer that shuffles 1,000 decks perfectly after every single hand. You cannot outprocess the house. Retail traders are entirely outmatched in the millisecond arena.
I'm sorry, but I just don't buy that. Let me tell you why. Your argument assumes retail traders must beat the AI to succeed. They don't.
They share the same order book. How do they not compete?
Because ECNs are a zero-sum arena. Profitable day traders do not need to outpace supercomputers. They only need to outdiscipline the 40% of retail participants who quit within a month. Look closely at the data. Both profitable and unprofitable retail traders buy the exact same stocks at the exact same times, typically the volatile morning open and the afternoon close.
Okay.
The Garvey and Murphy study showed the correlation between the gross profits on the worst 50 stocks for losing traders and the winning stocks for profitable traders was negative 0.60.
Wait, explain the mechanism behind that negative correlation for a moment, because that is a vital point.
It means the winners are quite literally buying what the losers are panic selling. It is a direct transfer of wealth from the emotional trader to the disciplined trader. The difference isn't that the winner has a faster computer or a better AI. The difference is entirely in strict execution and risk parameters. The successful trader is extracting capital from emotional peers who lack the discipline to honor a stop loss.
But the environment itself induces that lack of discipline. The individuals logging on every morning are crushed by the sheer speed and volatility of the intraday market. Human beings aren't built to process financial loss in milliseconds.
Which is why they need rules. Or they need to step back. Swing trading steps back from that entirely. It utilizes daily or weekly charts to smooth out all of that intraday volatility and highlights actual institutional behavior. When you look at price compression over multiple weeks, you see the true trend. But you also see a lot of dead time.
It is completely untainted by algorithmic noise or high-frequency spoofing. If a stock consolidates tightly for 3 weeks before breaking higher, you know it is being accumulated quietly by large funds. You do not have to fight the algorithms. You just ride the wake of the institutional ships once they get moving.
The noise you want to avoid is exactly where the opportunity lives. You cite the Cambridge study, but institutional day traders average 18% annual returns. I fully acknowledge those are professionals, but the mechanics they use are available to the retail sector now. By isolating a specific time frame, say the opening range breakout, a trader can capitalize on the predictable emotional panic of the retail herd at 9:30 a.m.
The retail herd that makes up a fraction of the volume?
Actually, retail investors now make up 20% to 25% of overall market activity, peaking at 35% during high volatility events. That is a massive pool of undisciplined capital waiting to be extracted by a systematic day trader.
But playing in that volatility is dangerous.
Furthermore, when you look at the 24/7 crypto and forex markets, extended trading hours now account for 11% of total daily volume. Pre-market activity has grown 15 times since 2019. That means day traders have more opportunities to find those exact inefficiencies. They don't need to predict a complex, multi-week macroeconomic trend. They just need to find a momentary imbalance in order flow and exploit it.
But that constant 24/7 access is exactly what creates devastating stress. The psychological toll of day trading is immense. We see mental traps constantly.
Mental traps exist in swing trading too.
Not at this velocity. Take the disposition effect, the psychological mechanism where a trader feels an overwhelming urge to sell their winning positions too early just to lock in a feeling of success, while holding on to their losing positions indefinitely, hoping they will bounce back to break even. That, combined with revenge trading after a loss, inevitably leads to account blowouts.
Which again comes back to discipline.
Then you introduce the mechanics of margin. On average, margin trades yield a return of negative 4.53%, while the borrowing costs you pay to the broker sit between 7% and 10%. It is a mathematical recipe for destruction. Swing trading, conversely, requires perhaps 30 minutes of monitoring a week.
30 minutes, that seems a bit light.
Decisions are made outside market hours when the chart is frozen, entirely removing the emotional interference of the blinking cursor. Think about the pattern day trader rule. It was implemented for a reason. Requiring a $25,000 balance was a regulatory attempt to protect undercapitalized individuals from destroying their life savings through high-frequency churn.
And it inadvertently trapped them. By requiring $25,000, the regulation forced undercapitalized traders into holding losing positions overnight simply because they were out of legally permitted day trades. They were staring at a red screen at 3:55 p.m., knowing they should sell, but couldn't because their broker would lock their account.
Well, they shouldn't have been in that position to begin with.
That is incredibly dangerous. Simulated prop firms solve this regulatory trap by providing the capital structure. I understand the appeal of a relaxed swing trading schedule, but you have to consider the uncontrollable nature of overnight risk.
That's a compelling argument. But have you considered holding multi-day positions exposes your capital to earnings shocks, macroeconomic data releases, and geopolitical events while the markets are closed?
You mean the gap risk?
Exactly. Imagine holding a swing trade, feeling great about a 5% gain. You go to sleep. At 4:15 p.m., the company releases a terrible earnings report. The stock drops 20% in after-hours trading. You literally can't react.
Well, your stop loss order will not execute until the market opens the next morning at 9:30 a.m., at which point it executes at the new, drastically lower price. Day trading guarantees a flat position at the closing bell. There's immense psychological safety in knowing that when you close your laptop, your exposure to the global economy is exactly zero.
You describe safety, but I look at the simulated prop firm model you were advocating for, and I really have to ask about the mechanics of their operation. Is this genuinely a safer structural path? Or is it just a gamified system designed to collect evaluation fees from inexperienced participants?
How is it gamified? It enforces strict limits.
Let us talk about trailing drawdowns. These firms implement strict 9% profit targets against trailing drawdowns, meaning if your account goes up, your failure threshold follows you up. If you make money and then give some back, you lose the account even if your balance is higher than when you started. Given that 97% of traders fail, it appears the entire business model relies on collecting the $42 to $467 fees from people who will inevitably break the complex rules. It feels highly extractive.
Look, it is a valid critique of the industry's overarching business model, but for the individual trader who knows how to operate within it, it is an unparalleled risk management tool. Think about what a strict 3% daily drawdown limit actually does mathematically.
It kicks you out of your account.
Mandatory circuit breaker. If Jamal, a trader highlighted in the recent prop firm data, limits his average losing day to $550 and keeps all absolute losses under $1,000, he mathematically prevents the emotional spirals that cause account blowouts. Over a 30-day period, he made $31,660 despite having 7 losing days.
That's one successful trader out of thousands.
The prop firm enforces the discipline that human psychology naturally lacks. If you get angry and try to revenge trade, the platform simply locks you out for the day. It saves you from yourself.
But it also places an artificial time pressure on the trader to perform and hit that profit target, which breeds the very overtrading and anxiety we are trying to avoid. When you swing trade, you let the trades develop naturally based on the asset's actual rhythm. You place your stop loss based on market structure, perhaps just below a multi-week consolidation range, not a rigid daily percentage arbitrarily imposed by a third-party firm.
But then you're stuck holding it.
you let the winners run for weeks. Furthermore, the tax structure in many jurisdictions heavily favors longer holding periods. In the UK, spread betting profits might be tax-free, but standard swing trading can fall under lower capital gains tax rates. Conversely, day trading profits might be classified as standard income tax, which drastically reduces your net yield.
Taxes only matter if you are actually making a profit, right? And my argument is that day trading, specifically through these protected virtual capital vehicles, allows a trader to practice, refine their edge, and extract profit without ever risking personal ruin. You are evaluating markets based on real-time order flow, looking at level 2 pricing data to see exactly where the buyers and sellers are sitting on the exchange. You learn to manage risk actively.
But you're still dealing with thesis drift, even intraday.
Swing traders face thesis drift far more often. We see it all the time. A swing trader buys a stock, it drops 10%, and instead of cutting it, they hold it for days, reading news articles, hoping the fundamentals will somehow reverse. The disciplined day trader simply accepts the mathematical loss at 4 p.m., clears their head, and starts completely fresh the next morning.
As we review the landscape of this issue, I maintain that swing trading fundamentally aligns with statistical probability, lower transaction friction, and a balanced human psychology by stepping back from the microscopic noise of intraday charts and operating on daily or weekly data. The retail participants can avoid the mathematical drag of commissions and the emotional devastation of high-frequency decision-making.
I mean, if you want to leave your capital exposed overnight, sure.
Swing trading allows the individual to operate logically outside of active market hours and build a sustainable methodology that genuinely complements a full-time career without trying to outpace artificial intelligence.
And I maintain that day trading provides unmatched active risk control, specifically regarding the elimination of that overnight gap exposure. By treating the market as a highly disciplined zero-sum environment, and by utilizing simulated prop firm capital rather than risking personal savings, the intraday participant can extract capital safely.
Even with the fees.
Yes, they do this by capitalizing on the emotional mistakes of other retail traders. The technology and structures available today, from ECN liquidity rebates to firm-mandated daily loss limits, make the intraday arena highly viable for those willing to put in the time to master the discipline.
While we certainly acknowledge clear points of convergence in the data, we both completely agree that treating the market like a casino guarantees absolute failure. Proper mathematical risk management, such as strictly risking no more than 1% of your total capital per trade, is non-negotiable regardless of the time frame you choose.
Right. Without strict risk management, both intraday and multi-day strategies will inevitably drain an account.
We also agree that the S&P 500 benchmark remains a very high bar for anyone to clear. Earning 11% to 17% annually in a passive index fund means any active strategy, whether it is day trading or swing trading, must genuinely justify the extensive effort, the educational time, and the risk involved. Beating the market is not an easy endeavor for anyone.
It definitely isn't.
Data on trader psychology and market microstructure. We will not declare a definitive path today, leaving it entirely up to the listener to weigh the mechanics and decide which methodology best aligns with their own capital base, psychological makeup, and risk tolerance.
Absolutely. Both paths demand extreme emotional discipline and a willingness to understand the deep mathematical mechanics operating beneath the surface of the price action. Which brings us back to the suspension bridge we discussed at the start. Whether you choose to inspect the tension on the individual bolts minute by minute or survey the stability of the entire structural span week by week, the math has to check out or the whole thing comes down.